Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Guys, thanks for tuning in. We appreciate you watching. We're going to talk about some exciting things tonight. We're talking about real estate syndication, and we've got the king of syndication here, Tim Bratz. He's amazing. He knows this inside and out. I'm asked a lot about how do you fund deals? Where do you get the money? Everybody wants to be in real estate investing. Not everybody, but everybody that wants to be in real estate investing, they have the same questions. How do I raise the capital? Do I need bank loans for everything? So, guys, sometimes with this, you'd have to live 250 years to get what some of these real estate investors obtain. And, if you did it one deal at a time, that's fine for some people, but it can really be a slow way to go. Tim, welcome to our show.
I'm excited to be here, man. We had a great conversation last time I was here. I got a ton of respect for you and a ton of respect for your show and how much value you put out there, man. So it's great to be back. I appreciate it, Todd.
We appreciate your time. We know you're a busy guy, so thank you so much. And, one of the nice things I like about you, Tim, is you're an open book. We just, we talked about that. So tonight we're going to get real. We're going to tell people what it's really like to be like a Tim Bratz. And, man, just give everybody the high level on Tim Bratz. I know so much about you, man, but tell everybody who you are and a little bit about what you do.
Yeah, I mean, obviously I've been on here before, so if you guys haven't, go and rewatch that episode. I think we go a little bit into it, but high level, I'm a kid from Cleveland, Ohio. I was going through college when the market was going crazy last time, 03 to 07. Everybody's making money. I was inspired by that and wanted to go and make some money. And so I got involved in real estate when I graduated from college in 2007, moved to the Northeast, moved out to New York City and got a real estate license. I thought, that's how you got involved in real estate, and then brokered a couple of deals. And I had a real estate license with a commercial brokerage that did like retail leasing and investment sales and office leases. And, I'm low kid on the totem pole. I was 22 years old and brokered a lease that was like on a side street in Greenwich Village. 400 square feet, and they signed a lease for $10,000 a month on that space for 12 years with a 4% annual increase. And so that was really kind of like getting hit in the head of like, I need to be owning some real estate too. And so I love New York. It was just, I wanted more like kind of a lifestyle. It was just kind of a bad winter. I'm from Ohio, so I'm used to bad winters, and I was young and wanted to move down south. So I moved down to Charleston, South Carolina. And that's when I started investing, or I started like learning, went through that whole analysis paralysis. I think that a lot of people go through. I need to learn everything before I do anything. And kind of fortunately, the market collapsed while I was going through that. In 2008, the whole market collapses. And right when I showed up to the party, ready to start buying real estate, everybody's running out the back door saying, run, 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 get out of here. But it was kind of fortunate where it was very different than today's market, right? Today's market, there's money everywhere and deals are a lot harder to come by. Back in 2009, there were deals everywhere. You couldn't walk down the street without running into, every two houses you could buy for pennies on the dollar. You literally had your pick of any property you wanted at a ridiculous price point. But the money, at least for me, right? I was 22, 23 years old at that time. It was very, very hard to come by. And so nobody was raising their hand, lending money. And kind of, bring it full circle on today's topic, which is a lot about raising capital and syndications, is you had to get creative. Back then I creatively financed deals. I got seller financing. I raised private money, and really I bought my first house on my credit card even. So it gave me a lot of adversity to work through and things that I had to overcome, and really become resourceful enough to find ways to fund these deals when a lot of the traditional ways of raising capital weren't available for me. So fast forward to today, I've had a lot of ups, a lot of downs, and just been through more and overcome probably more problems than most other people have. And that's typically the secret to having some success. So today I have a little over 4,000 doors, mostly apartments, about 95% of it's apartments. And I have a couple other asset classes, self-storage, high-end, like luxury Airbnb properties, a few of those, mostly for my own lifestyle. I just want someplace cool to go up in the mountains, and then we rent it out the rest of the year, or someplace down on the water and rent it out the rest of the year. And so, I mean, that's kind of the high level, but I've raised, my portfolio is probably around $400 million, right? And we've raised, I'm into it for probably around 300 million, maybe a little bit less. And, we raise about 20-25% of that from private money. So you're talking, and that's just what I have right now. That doesn't include all the other deals that I've done. So I've raised around $100 million of private money from mom and pop entrepreneurs like you and me, people who, I've never raised institutional equity, is what it's called, institutional capital, for my deals.
Where did the rest of the money come from? I mean, is it your cash? Is it, I mean, if you were in about 300 million and you raised 100 million.
So I'll go to a bank loan and they'll give me the funding for, typically 80% of the deal. And then we raise the other 20% for the down payment, and then a little bit more for operating capital. And most of the deals that I do are pretty distressed, value add kind of opportunities, right? Just like when you're flipping a house, you're looking for the ugliest house on the best street. I'm looking for the most distressed apartment building in the best neighborhood. And that's where you get the most appreciation when you put that sweat equity in.
And there's so much to unpack here. So in 2008, when you were really starting to get into it, it's interesting that you say, that you started in a time when traditional financing wasn't really an option. And that helped you really think of a lot of creative ways to get the deals done. That is so true, but also coupled with that, and I see a lot of people struggle with this, when it's not your primary business, it's really hard. And when it's speculation, it's not something you're going to live in, you're going to use it as a rental, or you're going to flip it. The banks are really looking at you and they're saying, like, what are your qualifications to even do this? Like, if you've never done this before, and then coupled with that, you were 22 years old. So you really overcame a lot of adversity then. Where do you think we are in the market right now? And I know we're not dealing with an 08, but you had mentioned the market is crazy. Deals are expensive. People are paying more. I mean, the profit margins are, smaller. The room for making mistakes is less. Where do you see we are right now with the market? Do you think we're going to see it continue to keep going up, or do you think we're going to see some kind of a reset or, slowdown?
Yeah, I think it depends on the micro market that you're in, right? If you could take a look at the United States as a whole, there's a couple things that we can discuss on that front. And one of them is 2008, very different than today's hot market, right? 2008, they were just giving money to people who didn't qualify and didn't have the financial wherewithal to manage money, right? Unfortunately, there's some people who just cannot understand that they shouldn't go and buy money that they don't have, right? Like don't go and rack up your credit cards, which I did this. This is how I went broke when I was 20 in 2012. I bought the Mercedes and I joined the private clubs and I took these fancy vacations and I just put it all on the credit card thinking, success in the future would pay for it of some sort, I guess. And I went completely broke because of it. So, I learned that lesson the hard way. And there's a lot of people who just, live that way, right? Where they, and that's what happened. A lot of people, and probably this would have happened to me if I would have gotten involved in real estate 2 years prior. I would have taken out, a no doc, stated income type of a loan too, and took all this money off the table and then just bought a bunch of real estate. And I probably would not be here today because that would have set me back so much. Because I wasn't a good steward of capital like I am today. So I think there's a lot of that happened back then. It was easy access to money. It was loose lending. It was people who shouldn't have been landlords were landlords. And I don't mean that in like a derogatory way, just people who haven't been educated on that had access to easy capital, and it's a business, right? It's like, taking your money and going and starting a manufacturing company. I don't know anything about manufacturing. If you gave me money to go start a manufacturing company right now, I would go out of business, right? So anybody who's not educated on it is going to have a tough time. And that happened freely with money in 2008. Today is different, right? Supply's been down. Demand is up. Interest rates are so low. It's like free money. When you think about the amount of payments that what the monthly payment is, as the interest rate lowers, you can afford more house. So naturally, home values are going to go up. Obviously, COVID, derailed the entire work from an office type of a scenario. So a lot of people are working remotely. And I'm not really up in the Northeast or in the Midwest anymore. I still have some properties in some of those markets, but I am in the Southeast. And what I can tell you is there's a boatload of people coming to Charleston, South Carolina. There are a boatload of people coming to Florida and going to Texas and going to Arizona from California and the Pacific Northwest and the Northeast and the Midwest. And there's a lot of people moving from the north down south. And so I think the southern markets are going to stay very, very strong. As far as like residential housing, I'm not really in residential housing that much, right? Majority of my portfolio is multifamily. So from that perspective, I think some micro markets are going to crush and they're going to do amazing. And I think there's going to be other ones that potentially are, in different Midwestern markets or Northeastern markets where people are moving away from, where single family might struggle. Interest rates are going to go up. The Fed's already said that they're going to hike rates. It was 3 times is what they told us back around New Year's. And since then, just over the past few weeks, they said it could be 6 to 7 times that they hike up rates this year. And as rates go up, buying power comes down because now you're spending more money on interest on your monthly payment than you are on paying down principal on it. So you can't pay as much for the property. So that's going to chill out, I think, on some of the home values as far as residential goes. Rental properties are at a different capacity, right? Rental properties are valued based on the income approach, not based on the comparable approach, right? A house that you're looking at as that you're brokering, you're looking at another house down the street with the same bedroom, same bathroom, same square footage that you're going to value that based on. And on the income approach, on any rental properties, it's based on a profit and loss statement. It's based on how much money does it make? What are the expenses and what's the net operating income? And then it's a multiple of that net operating income is how that property is valued. And so the variables are much less, almost non-existent as far as comparables go. The variables that affect the value in a multifamily property or in any rental property is the income and then the expenses. So what's key to understand here is rents are rising like crazy because as inflation grows, rental real estate is really the only thing that rises along with inflation and can secure yourself against inflation. So even if interest rates rise, rents are rising faster. So as rents rise even faster, it increases the net operating income to the property. So even though the interest rates rise, cap rates will rise, which means values will come down. But at the end of the day, the net operating income is more. So really values, I think, are going to sustain pretty well in rental real estate. I hope that makes sense. I hope I explained that.
Yeah. No, definitely. I mean, I agree with you 100%. I think that, rents always follow inflation because people can afford to pay more for the rent and they're making more money. So of course that goes up as well.
And you see inflation, like it didn't really happen last time because everybody got their legs taken out in 2008. So even though there was a bunch of money pushed into the economy, people were so fearful that they put it all in their pockets and they didn't spend it. So you didn't see inflation 15, 12 years ago, right? The difference today is the economy is pretty good for most people. Even people who aren't working, who are out of a job because of COVID, are still getting free money from the government and all these subsidies, and they're going and spending it. So all this trillions of dollars exactly has been infused into the economy, and people are freely spending it. So that's why you see Taco Bell starting wage at $18 an hour. That's why you see baristas at Starbucks starting at $22 an hour. You're already seeing it in the economy in a very abbreviated amount of time. And I think it's going to be exacerbated as a little bit more of this stuff comes into play. So you want to be in investments that are backed or that can combat inflation. And really, there's not that many of them that do. Gold, silver, precious metals. They could use crypto, maybe some emerging markets, but this has been a global thing. So I don't really see like new stocks in emerging markets or Brazil or Russia or China or anything. So I'd stick to rental real estate.
Yeah, you're not as impacted too when the markets, like you said, when the property values decline, you're still getting the same amount of rents. Mm-hmm. So as long as you can hold on to it,
you can ride out any economic storm if the rents cover your operating expenses and your debt service.
If you're building houses, I remember I was in 2008. I was heavily affected by, I just didn't see it coming. I've been in the business for a very long time. And it was as soon as the headline in the Baltimore Sun said the overpriced Baltimore housing market, and that started in 2005 when that posted in the spring of 2005, instantly we saw a drop in prices. Well, the problem is when you're building or you're rehabbing and you're renovating, when something like that happens and your values instantly decline and your only way to success or survival was basing it on a profit on that property, maybe $25,000 or $50,000, whatever you were planning, we were instantly seeing values go. And to give you an example, from like $749 to $625, $615. A lot of times, that's all your profit plus an ouch factor when you're coming out of pocket with something that you planned on making money. So I think it's amazing. And we'll talk next about the actual, syndication. What is syndication? How did you decide to do it? But at what point was the switch to where, you said, what, if I go this track, being in the real estate business, it's going to take me 250 years to get what I want, for yourself and for how many people you provide for. When was that switch? How did that look?
Yeah. So in 2012, like I told you, I chased some shiny objects, found myself $25,000 in credit card debt, $80 in my bank account, and I had to move back to Ohio, move back in with my parents at the age of 27. And the thing that saved me was I sold my own primary residence, which had some equity built up into it. And so real estate saved me. So I'm like, I'm going back in, all into real estate. Because I chased some other opportunities, business opportunities and stuff. And so I sold a few properties that I had accumulated down here in Charleston. So I got back into real estate in late 2012. And I was doing a little bit of everything, like flipping houses, single family rentals again. And then I found an 8-unit apartment building on the MLS that was just so cheap. This is 2012. This is the bottom of the market. All the foreclosures were already, coming on the market, and for a couple of years, it was just like horrible. As far as like for the banks, but if you had money, you had the opportunity to go buy stuff, you were in a great position to buy at a very low cost basis. And so this apartment building, an 8-unit building in a C-class neighborhood, came on the market, and it was so cheap that I couldn't not buy it. So I bought it. And after I bought it, and I bought one property, it was 8 units, right? Instead of 8 properties to get 8 units. I was like, wow, this is a lot easier. I set up utilities for 1 property instead of 8 properties. I paid 1 tax bill instead of 8 tax bills. I met my contractor at 1 location instead of 8 locations. I met tenants at 1 location to do an open house versus 8 different locations, right? And so I've always had like this sense of efficiency about me. Like I hate wasting time. I hate wasting money. I hate wasting all that kind of stuff. And so like the scale and the sense of efficiency really resonated with me when I bought that first apartment building. And I was like, we need to do more of this. So bought another small building, and it just organically built up a portfolio up to about 140 doors with a couple of partners over the next 3 years. Now that partnership ended up going south. As some partnerships do.
I say the only ship that sinks is a partnership. I've had a couple of them through my, entrepreneurship, my tenure through the years. But yeah, it's tough.
Yeah.
So these partners, they were actual operating partners. They weren't just giving
I was
you
doing
the
all
money?
the operations. They were the money guys. So
Yeah.
they came to me when I was moving back to Ohio, and they said, hey, we made money in this other business, so that way we could eventually put it into real estate. Let's partner up. I did 100% of the work. They put up the cash, and they kept 67% of the ownership in all these deals. I had 33%. So, and I worked my tail off, right? I did literally everything, every aspect of it, finding the deals, negotiating the deals, setting up utilities, bookkeeping, collecting rents, swinging the hammer, meeting contractors, posting eviction notices, all of it.
How did you know them?
Through another business venture.
So they were just people that you knew had money, and you just called them up, or they called you? I mean, how did
they called me up? Yeah. So the previous business venture, all right, so back up. I'm in Charleston, South Carolina, 2009. I buy my first house. I flip it, make a couple bucks. And then I got into owning some rentals. I built up a portfolio of 10 rentals over the next year and a half and 2 years, whatever it was. So I had 10 units, including my own home that I was house hacking and renting out a couple rooms to my buddies. And got invited to a network marketing meeting, and the network marketing company had a bunch of home services. So they offered home security, TV, internet, phone, electricity, natural gas, because of the deregulation, a lot of that stuff. And I'm like, I'm in real estate. This makes a lot of sense. I can offer this to my tenants. And I know a lot of other people in real estate who could offer it to their tenants and use it on their own property. So I pursued that network marketing company and spent a lot of time, spent a lot of money building that as an organization. I had some success and got some attention from some pretty higher ups. And so I had a little bit of success, but not a lot of money. So after 2 years of really just kind of drinking the juice and buying into this thing, it was amazing from a personal development standpoint. Met some incredible entrepreneurs there. But I just realized this isn't where I want to be long-term. And so I ended up leaving that company. And as I left that company, two of the very high up people reached out to me, and they said they were senior vice presidents in the company. They were making, 6 figures a month there. And they said, hey, we're in this business because we want to get involved in real estate. I had a pretty good relationship with them. And they said, we'll put up the money and you do the work. So they put up about $300,000 initially for the first year. I bought little houses, little buildings, flipped some houses, had some success. After 6, 8, 9 months, they started bringing us a little bit more cash, and they ended up bringing about $1 million, a little over $1 million, I think, total. And so, but I had an exclusive partnership with them. I don't mind joint venture partnerships, but I don't like exclusive partnerships. So because of this reason, right? They were going in one direction. My value continued to grow as they didn't want to bring any more money. So their value continued to diminish. I'm getting more and more valuable, getting people knocking on my door saying, hey, can we do this? Can we do that? Let's do some deals together. And these guys are like, no, we're not doing that. No, I don't want to pay you to go to a mastermind group. No, we can handle this ourselves. Oh, hey, Tim, you want a salary? Then you need to fire the property manager and you should take that on. And we weren't building a real business. I wanted to build a business instead of just a job and working for these guys. And we started clashing, and one thing led to another. And we just said, hey, let's just liquidate everything. So I built up about 140 doors just on my own. And then we liquidated those starting in 2015, I want to say 2015, 2016, whatever it was. And so liquidated those, but then I had this huge just weight off my shoulders, and I was able to start building out a team, and I went back to flipping a little bit just to keep the lights on, and then building up the real estate, the investment and portfolio from rentals and buying apartment buildings again. And that really opened me up. I had opportunities where I could joint venture on a deal by deal basis with different operators, different money partners, and allow myself to test somebody out, right? It's like dating before you get married. You want to make sure that core values align, right? Visions align. How do you act when you're making money? How do you act when you're not making money? That really tells, how people are gonna respond long term. So,
man, isn't that the truth? Jeez, the real personalities come out then when you're not making money.
And sometimes they're even nastier when you're making money. We were making money with that partnership. We had a bunch of I built it up. We had millions of dollars of equity. in that business. And it was like the greed starts coming out, right?
Yeah.
And then, yeah, people are very stressed when you're not making money, and that's understandable. But I mean, do people sink or do they swim in that situation? And you just got to be aware of it.
So explain to people what a joint venture is. JV is the term. When you hear people saying, "Hey, I'm looking for a JV," or I need a JV, someone to JV with. Tell people what that is.
Yeah, I think that there's a couple different definitions and a couple different ways of looking at it. And here's, to the listeners, there is not one way to make money in real estate. There are many different ways to make money, and there are many different ways to structure a deal. Even if you're only if you're in apartments, you can structure it. There's two different sides of the spectrum. You can do a traditional syndication, or you could take down the deal yourself and fund it yourself, or just pay a debt, or So let's kind of talk about, I think, some of those from a joint venture perspective. To answer your question first, I think of that from like an operating partner, right? So to me, I have a deal in Texas, 500 units in Houston, Texas. And I have a joint venture partner who's local to that deal. And he oversees the boots on the ground operations of it. He's the one walking the property every week. He's the one overseeing the contractors and the construction and making sure that the management company's doing what they're supposed to be doing. So in my eyes, that's like a joint venture operating partner. Some people have a joint venture money partner that just downstrokes the entire amount of money, right? Like if the check is you're buying a $5 million deal and you need $1 million for the down payment, that joint venture money partner just strokes the whole check for $1 million down. And they have a big chunk of the equity in the deal, and then you have a piece of the equity as the operating partner, and then you guys joint venture in that capacity. So I've done a couple of those with a single partner before. And then there's not a lot of people who can write big checks,
But that's a deal by deal basis. So you're talking about, a joint venture, sort of like a partnership in one capacity on one specific deal.
Yep. And if that deal goes well and I like how you operate, you like how I operate, then let's go try out another one. And then we'll try out another one, and we'll try out another one.
So at this point, we're talking about that's a way of raising money, whether it's half yours, portion of it being yours, or none of it being yours, or just your partnership, part of that joint venture is to do the work. Mm-hmm. At that point, and I know we're going to get into the actual syndication aspect of where you have to file for SEC. I mean, I've, seen your shows, watched your videos. And by the way, guys, check Tim out, his YouTube channel, his social media. He gives away free information pretty much every day. I mean, he has these seminars that he puts on, and he's a good guy. We're talking to the best. So he knows this inside and out. He's tons of energy, great information. Check him out, please. All of his information is in the show notes. But let's talk about, so when you're talking about a joint venture, for the most part, that's a very simple way of doing things, right? Mm-hmm. So at that point, you're not filing with the Securities Exchange Commission.
So the hard and fast rule is if you have one investor to one deal, that you're not creating a security. All right. As soon as you take two investors and put them into a single deal, you are creating a security. Are there people who do deals where they bring on 2 or 3 money partners and come in to that deal and they don't file securities, filings? Yes, there's people who do that all the time. What's the likelihood? You got to weigh out the likelihood that you're going to get caught, the likelihood that the deal's going to go south, the likelihood that somebody's going to complain, what is all that stuff? The other thing that you pay attention to is if they have a voting right in that. Typically in a joint venture partnership, they have a voting right of, are we selling? Are we buying? Are we refinancing? Like, what is it? And they can help make decisions where they're not just a limited partner. They're actually a joint venture partner and an operating partner. That's not creating a security. So even if you had 2 people and you gave them, authority, like voting rights in that LLC, if they're just money partners, you bring a couple people in, but they have voting rights, then to my understanding, that's not a security. But if you're raising capital from people who are just writing you a check, Todd, let me just bring you a $100,000 check. You pay me an 8% return annually, kick me a little bit of equity in the deal. That is a limited partner. If there's a slip and fall, right? Somebody gets sued, the property gets sued, and probably Todd, if you're the operating partner, you might get listed as a defendant on that claim as well. But as a limited partner in that project, you have no liability. Could you get named? Technically, I guess you could get named, but it would get thrown out right away. So your only risk as a limited partner into a deal is the money that you put into that deal. Does that make sense?
Yes.
But you don't have any voting rights. And the reason it's a security is because of that, because they're not secured by anything other than some ownership interest, right? So in the LLC, so there's not a promissory note. There's not a second mortgage that they get. The only way that they're secured is by interest in the LLC. So if 123 Main Street is owned by 123 Main Street LLC, that limited partner would invest in 123 Main Street LLC, and they'd have a little percentage of ownership in 123 Main Street LLC. And that's the only way that they're secured. And they're secured for, you can draft up the operating agreement, anything that you want. If the managing member lies, cheats, steals, is grossly negligent, fraudulent, they have a fiduciary duty to you, right? Like, you can draft any of that kind of stuff up and make sure, it's as tight as you want it to be and what makes you comfortable. So there is comfort in that. But yeah, I mean, it's technically you're investing in something and nothing's guaranteed, right? It's like investing in a stock of a company. Could go up, could go down. That's a security, and that's what you're investing in.
You say there are a lot of people out there that could, that do this. And I'm sure, there are a lot of people that do a lot of different things. And, I always say that everything's okay until it isn't. Right? It's, and when isn't it okay? It's usually when people feel like they've been harmed in some way. And a loss is a harm to people. So, if somebody, you may be fine if you're returning what you promise, and we're not advisors, we're not lawyers, we're not accountants, we're not, guys, we're just basically going off experience and the opinions and experiences of, like, Tim, the investor or the operator in this case. But when somebody doesn't get what they feel they were promised, they get upset. And I've heard that, that's federal at that point, right? If you're doing something that you should have filed with the Securities Exchange Commission, you
can get so jammed up that you're never allowed to raise private money ever again.
Wow.
So it could totally ruin your career. And here's the thing. Like, why? If you want to build a real business, I have this conversation with people who are like, oh, I only want 1099 employees. You want a real business? Yeah, I want a real business that works for me. Well, guess what? Real businesses have W-2 employees. Freaking just hire somebody and pay the employer taxes, right? It's the same thing with, like, documentation. Like, if you want a real business, if you want to build a real portfolio that's going to create legacy wealth for you and your family, how about just doing the right paperwork? How about spending a couple bucks and having an attorney draft it? And I think what a lot of people don't realize is the documentation's meant to protect everybody, not just the investors, but also the operating partner. There's disclaimers in there and disclosures in there of everything in the deal. And if you disclose the deal, if you disclose everything in the deal, it eliminates the liability on the operating partner, right? Here's the deal we're buying. Here's the financial performance is. Here's the game plan with it. Here's what we're going to do. A meteor could hit this thing. It could burn down, but that's why we have insurance. And then, and it talks about everything. So that way, if a deal does go south, and you do lose somebody's money, the investors come in and sue the operating partner. Hey, you're a grown-up, right? You're a big boy. You're a big girl. They looked at the document, right? Yeah, it's all documented, and we signed off on this, and you knew that your risk was to the level of the investment that you made. So it's beneficial on that front. And at the same time, the investor knows that the operating partner has a fiduciary duty to do what's right for the deal, and they're disclosing everything. And if they don't disclose something, that's fraud, and they can then go after them for that. Yeah. So, you have to be aware that it protects everybody in it. So it's better to just do the right thing and not play in the gray area. Just keep it black and white.
Can you tell us about your first syndication?
Oh man, this is actually a really really powerful story. I know we talked right before we got started about like, hey, tell us the good, tell us the bad, like whatever you're willing to share. And I'm willing to share. But all right, so I had a few hundred units in 2017. I built it back up after that partnership went south, and I had a few hundred units. And going into 2018, one of my buddies sold his e-commerce business, and I think for about $40 million. So he had some cash that he was sitting on and put a few $1 million with me pretty quickly, where I was able to buy another $7 million worth of, no, more than that, about $10 million worth of property, which back then bought a lot of doors before it was like really, really cool to start getting into apartments. So I got myself up to around 600 units in early 2018. And had some excitement, was talking about it on social media, and had like a lot of people, looking. And I came across a great deal down in Georgia of a heavy value add. It was some very wealthy bankers, some Wall Street guys who had bought it, making so much money on Wall Street. They just, blindly put money into buying this apartment complex, but they didn't have any experience in real estate. They didn't partner with anybody who had experience in real estate, and they didn't interview the management company. So the properties went straight down. They were 50% occupied when I contracted them, or one of my joint venture partners contracted them. And so we had a great value add opportunity. 700 doors for $10 million is what this opportunity was, what we were buying. So it was $15,000 per unit, but it needed another $20,000 per unit to go in across the entire portfolio. So it was a lot of work. So I look at the numbers on this thing. I was like, man, this thing's worth a lot more money, right? This is probably worth $40 million. We'll be all in for about $25 million. And my buddy sends it to me, who's the Georgia guy. And he sends me the deal. He's like, can you raise the $4 million that we need for the down payment on this? I said, yeah, absolutely. Or let me see. I don't know. I've never raised that much money before. The most I've ever raised for any single deal was $900,000. So $4 million was like, puts a little lump in your throat. And, but my buddy just sold his company. All right. And so in a roundabout way, I'm like, hey man, I sent him a text message. Do you know anybody? I got a smoking deal. Do you know anybody who might be able to bring $4 million or any portion of that, wink, wink, to this deal? And he's like, let me ask around. I'll get back to you in the next day or two. 20 minutes later, he texts me. He's like, I got it. I was like, what'd you get? He's the money. I was like, the money for what? The deal. I was like, what? How much? 4 million. You said you need 4 million. I got 4 million. You got $4 million in 20 minutes. And this was my responsibility. My responsibility was to sponsor the loan and to raise the capital. Okay. Otherwise, I'm hands off. So guess what? I'll sign the loan at closing. That's an easy, hour of my time. And then I just raised all $4 million in a text message. So I'm sitting pretty for the next 3 months while all the due diligence is under process and the loan is getting put in place. And my partner's lining up the contractors to rip the roofs off the day of closing and getting all the quotes and the bids and insurance and all these different things in place. I'm hanging out, right? I did my part. So it comes up about 2 weeks prior to closing. We're closing, I think it was the first full week in June, like June 9th or something. And it was like right around Memorial Day. And I shoot my buddy a message. I say, hey, we're going to close in like 2 weeks. I'll get you the wiring information for the $4 million as soon as we have the account set up. And I just want to give you a heads up so you can start moving the money around or do whatever you got to do. And he goes, yeah, cool. I don't have it all right now, but I'll get it. And I was like, what does that mean? You told me 3 months ago that you had it. He's like, well, I'm launching this thing, and I'm going to Africa, and I have a bunch of like high net worth individuals and families and corporations, and even like some royal families investing in my new business, and I'm gonna use that money to invest in this. And all I hear is like Nigerian prince scheme, right? Like somebody sent him an email, and he's got totally taken. And so I'm like, oh my God, I can't believe I just put all my eggs in one basket. And I was like, oh, and he goes, don't worry. I'm speaking on Wednesday. And on Wednesday, I've already had soft commitments. I'll have all the hard commitments, paperwork signed, funded. We'll be all right. Yeah, it's going to be tight, but we'll be all set for the Monday closing. All right. So this is the Wednesday before Monday closing. And he's in Africa. He's this 8, 9, 10 time zones, whatever it is, away. So I wake up Wednesday morning. It's the end of the day after he had all these meetings, and I sent him a message. And all day I hear crickets. Didn't hear anything. All right. The next day is Thursday. Sent him a message. on Facebook Messenger, on WhatsApp, on email, on text, every way I can possibly reach out to him. And I don't hear anything. He's like, and then other than I'm working on it kind of a thing. Right. And then on Friday morning, I wake up to a message. He's like, dude, I can't get the money. I was like, all right, well, how much can you come up with? He's like, none. So
none.
It's Friday before a Monday closing. I've never raised $4 million before. This is the biggest deal of my career. It would actually put me on the map and put me over 1,000 doors. And the mortgage broker did his job, right? My business partner, the operating partner, did his job. He's got contractors ready to rip roofs off this place and replace all the roofs on Monday. The lender, which was a debt fund that we were working with, had done a couple small deals with, never asked where the $4 million was coming from. Never had to like source it or anything, like season it or anything like that. So they were just cool, right? Because we'd done a couple small deals. The real estate broker who went to bat for us saying, hey, I've closed some other really tough deals. These guys close. They will close on time. And yeah, there's higher offers out there, but you should go with these guys because they will close based on my experience with them. All of a sudden, like my reputation is on the line with all these people who have already done their job other than me. I'm the only one who didn't do their role. So it's like, I remember walking out on a Friday morning and just thinking like, of course this would happen, right? Like there's no easy button. Of course this would happen to me. Woe is me, feeling bad, just deflated. Oh my goodness. And I'm sitting outside. It's a beautiful June day. It's like the first week of June, and it's like 75 degrees. It's sunny. My kids are out running in the yard playing. My wife's bringing out food and drinks and hanging out. And I realized if this is my biggest problem, it's not a real problem, right? If my biggest problem is to raise $4 million to make $15 million, I got a pretty good situation, right? Like a problem's not really a problem if money can solve it, you know?
You need the money.
Yeah. And so I became extremely grateful, actually, like very, almost like, you know what? Like people would be cutting off their leg to have this problem, right? So like, let's own it. Let's go get to work. And so I made a list of everybody I knew with cash. Everybody I knew who was a real estate professional, every entrepreneur that I knew who had a business that might even have access to money, all my private money lenders that I've ever done a deal with, even if it was a small deal, and I reached out to everybody and made phone calls and did all this stuff. And so for legitimately all day Friday, I didn't go to bed until 3 o'clock in the morning, and I was up by 6 o'clock in the morning, making phone calls, sending personal text messages, sending personal emails. And I realized I couldn't talk to everybody. So it actually made me very efficient of like, how do I convey this information? So I drafted a very simple email with some bullet points on the deal. I attached kind of an investment summary. That was 2 pages, very simple, went over the project a little bit more in depth and went over the investor returns. But it gave people an opportunity to read the email. Okay, I like this. Let me go open the investment summary. Okay, I like this. And then I gave them a Dropbox link to all due diligence, everything they could possibly, appraisals, personal financials, or not my personal financials, but financial statements for each of the properties, demographic information, underwriting, pro forma, scopes of work, everything they could possibly want, leases, all of it. And so it was all in there, and they could go and answer any question they want by kind of going that. And then if they said, hey, I'm interested, then we can hop on a phone call. And I had worked harder than I had ever worked before and just worked my tail off for the next 2 days straight. And it was amazing because so many people didn't know that I raised money, didn't know that I structured deals, didn't know that I paid an 8 to 10% return and gave them equity in perpetuity even after they got their money back, right? Like, oh my goodness, I had no idea, right? I'm lending my money out at 8% right now, and I don't get any equity in perpetuity. You know, I don't get any cash flows. I don't get any depreciation. I don't get any of these other benefits. And so it opened up, I'm talking dozens, if not hundreds of doors of people that I spoke to about how we do deals. And these people, the limitation was timing. This is a Saturday. On a Monday, I need you to wire hundreds of thousands, if not millions of dollars on Monday morning. And so people, it's a summer weekend. People are out on the boat at their cabin, they're hanging out with the family. So I wasn't able to get people. It planted so many seeds for future capital raises. And 6 people came in and brought $4 million total, though. And here was the key.
Amazing.
2 people I had never done a deal with before, and they brought $200,000 each. And the other $3.6 million came from 4 people who I had done deals with before. That's the secret. That's the key. Because I had executed on small deals. One guy brought $1.5 million. And this one guy, I had done a $60,000 deal, a $140,000 deal, and he did a $200,000 transactional loan. And one of the flips, the $140,000 flip, went long. It was supposed to be a 6-month thing. It turned into 9 months, and I just communicated. So it didn't go well. I communicated to him. He got all his money back, got his return. Here's the point. I did 3 deals with this guy, and then over the course of a weekend, he went to the bank, moved all of his money around, and wired $1.5 million to me on essentially my reputation. Now, we had, I gave him a promissory note and that kind of stuff, but it was a short-term loan. He's like, hey, I'm going to give you the cash for the next 3 to 4 months while you backfill the syndication. So then I went, had all the documentation and everything put together, and I was able to backfill it and bring in syndicated, equity investors. But he was willing to come and bring a big chunk of the cash up front, so that way we could at least close the deal on that Monday. So here's the key: make a list of everybody you know, and plant seeds. Even if you don't have a deal, hey, I'm working on deals over the next 90 days, coming across some amazing rental properties, amazing multifamily properties, really shaping up nicely. I don't want to bring it to you until I'm get through all the due diligence, but I wanted to just kind of put it out there and see if it's something that you would be interested in passively partnering up on. Dude, that's a very easy way to say, hey, Todd, if I had a deal and it made a lot of sense, is that something you would be interested in investing in? All you need is them to say yes. Now there's already a familiarity. If you go to them and I say, Todd, I'm closing the deal on Monday. I need your money and as much money as you possibly have right now for this Monday closing. All of a sudden you feel like the prey, and the prey runs away when they're getting hunted, right? So instead, go fishing, right? Put the lure in the water, let people come to you. Hey, here's what I'm doing. Here's how I do it. If you're interested, shoot me a message or give me your email address, and I'll put you on the list, and I'll send you an email next time I come across a great deal.
It's almost like, I explain to people a lot. It's like banking. You have to make deposits. Well, we have to make deposits in people. And some of that is, it's interesting. Before you can make a withdrawal or expect them to do something, you have to build that trust and that relationship. And, there's so much in what you just said. And what I see is, when people they're wanting to get into the business, you really started out and understood the business. You built a lot of relationships along the way. You showed people that you were a person of integrity. And I've seen so many people speak about you in testimonials, and they all say the same thing. They all say, it's your integrity. It's your ability to do what you say. You pay others before you pay yourself. I mean, these are a lot of the things. These are character traits that you have to have in order to have people entrust you their money that they've worked very hard for. Everybody wants to make money, but showing how you built up and how you made the stay. So I think the adversity that you came across I was listening to one of your interviews. I don't remember the gentleman's name, but he was an older guy. And he had said that, one of the things that he said, which really resonated with me, was you have to go through adversity as an entrepreneur before you truly learn how to do it. I mean, you can't be afraid that things aren't going to work out. So you've got to start. And for people listening, if you're thinking about getting into this, there has to be a price to pay. And a lot of times, if you don't have the money as the price to pay, it's your experience and your willingness to go through it and perform and deliver, even when it seems like it's not possible. So listening to you, Tim, in this amazing story, was you were really concerned about your reputation. You had all these people going to bat for you. You didn't want to let them down. So that's what keeps showing up in your story, was that you put other people in front of you saying, wasn't the fact that you weren't going to make this $15 million, an instant equity or whatever. It was the fact that all these people gave you this because they knew who you were. Mm-hmm. So I think that's a great lesson to learn here for people listening, wanting to get into this. Start at a very achievable level. Understand that if you do it well at that level and you build the trust factor and the relationships with your vendors, with your lenders, with your partners, with your family, with people, they see how you behave. They see that you're taking it serious. It will pay off and be scalable very quickly. When you were raising this money, so when you thought your friend here that sold his business for $30 million, whatever it was, and he was going to give you $4 million, you trusted him because you can be trusted. So we have a tendency of doing that ourselves. You trusted him. Had you already aligned with the legal requirements for raising, or was he more like a JV? I mean, when do you have to file? When you realize that you're now pooling for money, at what point do the SEC filings need to be put in place, and what is that process like?
Yeah, so there's two major types, and there's a few other ones out there. Like Grant Cardone just came out with a non-accredited, but you can publicly solicit. But there's a lot more hoops to jump through on some of these things. But the two big ones are a 506C and a 506B. So a 506B is a little bit less, I wouldn't say less regulated, but less hoops to jump through, less paperwork. But it's all friends and family. It has to be prior existing relationships that you're raising money through. So, and social media doesn't count, right? It's got to be people that
your friend on Facebook is not right. Okay.
But there's not really a definition of what does that mean. The definition is a prior existing relationship. I have some attorneys who have told me, it could be a friend on Facebook. And I have other ones who are like, no, you need to talk to them on the phone, talk to them on text message. You need to have email correspondence, and the conversation has to be about money. And it's even better if you met them in person, right? And so that there's some that are pretty loose about it and some that are very disciplined about it. And so, I guess that depends on whatever your level of risk adversity is, And so whenever I go through the process, so on that deal, it was a little bit of a different deal because it was supposed to be one person bringing the entire check. So we didn't need securities documentation. Now, when I realized all that stuff was going on, I got short-term money to do the closing. And then I put the paperwork together, and then I went and raised the rest of the capital, right? So typically, though, in a deal, I'm buying a property down here in South Carolina right now at the end of February. And so that deal is under contract. We've gone through the entire due diligence phase. I know that I'm going to move forward with it. I feel very good about it. At that time, that's when I typically spend the money, because a private placement memorandum is somewhere between $10,000 to $20,000, depending on how complex it is, and depending on where you live and who the attorney is and all that stuff. I now have in-house attorneys, so I can have it done pretty quickly. But typically, it takes 2 to 3 weeks to get that turned around, especially on your first deal. If it's your second deal and you got a template and you want to structure it the same way, then yeah, they can get it done a little bit quicker.
Does it matter the size? So you say $20,000, that's the attorney's portion of that? Is that about right? And so whether it's a $10 million syndication or a $300,000 syndication, that's the cost.
Yep. It's the attorney's fees. And that's money that you're never going to see again, right? So if you end up not closing on that deal, but hey, welcome to the pros, right? Like, welcome to
business.
This is a cost of doing business. And so typically I'll contract a property. If I didn't have in-house attorneys, then I would probably start that process during the due diligence process and know that I'm kind of moving forward and start having the conversations with the attorneys and get that going. Because as soon as you do due diligence and you know 100% that you're moving forward, you need to be on the ball raising money. So let's call it a 30-day due diligence period and then 30 days to close thereafter. I like to make sure, because of this story that I just shared with you, I don't wait for them to wire funds the day before closing. I want to collect money as quickly as possible, as early as possible, and I'll start paying interest. Their interest starts accruing from the day that they wire money to me, but that allows me to not have to scramble for a bunch of cash a day before closing. There's 1,000 other things that you need to be aware of. So for me, I'm usually going to my investors about 6 weeks before closing, and I'm saying, hey, here's the deal. And what I do is I take my list of everybody who's ever inquired, anybody I've ever reached out to, and they say, hey, Tim, I'm interested in partner with you on a deal, bringing money to you as a limited partner. Great. So I put them on my email list. I send out an email to everybody with essentially the email with the bullet points and the email with the investment summary. And I say, hey, if this is something you're interested in, hop on the webinar. So I'm going to do a webinar on Thursday this week and have a bunch of people hop on that webinar. They register for it. And I spend about 45 minutes talking through the deal, my background, just so they know what I have going on and where I'm at with my business and what we do to mitigate risk and what our business philosophy and strategies are. And then talking about specifically that deal and then specifically about what the returns look like for that investor. And so that way it's a way to not have one-on-one calls. I don't like doing anything one-to-one. It's very inefficient, right? So I like doing one-to-many whenever I possibly can, which is why I love social media. I love podcasts. And I try to do that in everything that I do. So if I can send out one email, if I can host one webinar, then that's what I want to do. And then usually we have enough people in our database now. Like there's 400 active investors in our deals right now.
Wow.
Minimum $100,000 investment up to $5 million we got some people at. And so we have enough people where there's enough scarcity and enough all right, and they know me, or they've done deals with me. They know exactly how it is. Now it's just like, I need to know kind of the specifics and the details. All right, great. I'm in for 200,000. I'm in for 500,000 or whatever that looks like. So, and here's the key, Todd, is like, it's easy now because it was really hard at the beginning. It's really like, it takes years of planting seeds to all of a sudden have a forest grow. You know what I mean? Like you got to plant seeds, you got to cultivate those seeds, you got to continue those relationships, and fertilize and sun and soil and water and all of it before many, many years, right? I've been in real estate since, remember, 2009. So now it's easier. But guess what? If you just stick with it, if you push through those hard times, every year it gets easier and easier. Every year I have more and more access to capital. Every year I have more and more access to deals. Every year my business gets more and more profitable because of the scale and everything else, right? Every year I attract better talent to my team because of all these things. So the point is stick with it, right? Don't quit. Like you said, people are watching you. They're watching to see if you stick with it because we live in a society where most people don't.
Amen.
I'm hiring an executive assistant right now. And I'm looking at resumes, and there's resumes with people who left and moved jobs every single year. No wonder, like you've never gotten ahead. It's because you've never committed to anything. Why would I hire that person if they can't commit to themselves or anybody else? Why would they ever, commit to me? So, quick aside, but that's the process I go through, and then I get the commitments, give them all the documentation. They fill out. It's really a simple process for the investors. They fill out something called a subscription agreement. There's 4 documents. So one is a investor suitability questionnaire. And usually your investors have to fill out one of those per year. So if they're on a deal with you in January, you don't have to deal with it if they come into another deal later, right? So it's usually good for 12 months. Investor suitability questionnaire that just says, hey, I'm accredited, I'm not accredited. Here's, what I do, how I do it, all this stuff. Then there's a private placement memorandum. That's the big document that with all the disclosures, with all the disclaimers and everything. They don't have to do anything with that other than it's for their records. Then there's typically a term sheet that's kind of like a summary of the private placement memorandum. That's usually 5 to 7 pages long. And then they don't have to do anything with that. That's just kind of a executive summary of it. And then there's the subscription agreement, which is typically a 2, maybe 3-page document that just checks a couple boxes. Here's how many units I'm in for. Here's my contact information. Sign the bottom of it, and you're committed, right? And then we just add their name to the operating agreement later. They don't even have to sign the operating agreement. And that's the process, right? And I've done it dozens and dozens and dozens of times on the 506Bs, which is the friends and family, pre-existing relationships. Doesn't really have to be a family member, right? It's just prior existing relationships. Then there's 506C. 506C is general solicitation. You can go and take out a billboard if you want. You can go and put it on the side of a bus. Hey, raising money for this deal if you want. You can solicit on social media. One, you got to disclose that it's a 506C investment only for accredited investors. And then the second thing is, because it's only for accredited investors, they have to be accredited, obviously, right? So accreditation in this world means they have a net worth over $1 million, not including their primary home. Secondary residences, secondary homes, all that, vacation homes, that's okay. But their primary residence cannot be included. So they have to have $1 million net worth. It doesn't have to be liquid. It could be in business. It could be, whatever, in stocks, bonds, and real estate, whatever. Or they make $200,000 a year as an individual, or $300,000 a year as married couple filing jointly. So if you meet either one of those, then you are an accredited investor, and you can then invest in one of those deals. And like I said, there's a few other ones that have just come about over the past 12 months, but they're, got to get in the weeds on those. But those are the two big ones, and the two that I've done dozens of both of them.
So how big is your team right now?
On the investment side, we probably have 10 employees, and then I probably have another 5 on like my coaching and consulting side of things. But that's on the property level. I have employees at every single property as well, right? They're not part of like my core team, but you buy a property, 100-unit building, you probably have about 4 employees for every 100 units, probably 2 maintenance personnel, a property manager, and like a leasing agent. So if you got 4,000 doors, I probably have another 150 employees just on the property level as well.
Wow, boy, that's a lot.
It's a lot, and it's but it's like each one's its own business, kind of. Each one has its own, it's kind of siloed off, and so it's pretty easy to manage that level, right? Because my staff and my core team just manage it. We hop on phone calls, we do weekly calls with each property and any joint venture partners and all that kind of stuff. And I have a rock star team though. My team is just A+, like the highest caliber of people, and they're just amazing individuals. And listen, we all came up together, right? Like a couple of us went to high school together. One kid was an intern with me in 2015 and has worked his way up, and actually is an equity partner in the deal now. He's my acquisitions director, and he has a little piece of equity in every deal that we do now. So the key was they were loyal, right? They were very loyal, and they had great attitude, and there were some skinny years.
They were committed.
Very much so.
Exactly what you're talking about, right?
Yep.
They have to be committed.
And they stuck through it through thick and thin, and they deserve the equity that they have in these deals now. And I'm happy to pay it to them, right? And that allows me lifestyle too, and self-interest. I can go on vacation for 3 months and know that the business is still humming along and probably will be better when I get back,
I don't know that. Do you go on vacation for 3 months?
I never have. No, probably 3 weeks is the longest one I've ever been on.
So let's talk about, tell everybody, what is your life like, man? What do you get up and do every single day? Are you like in another city every single day? I
try not to, like I was doing a little bit of the coaching and teaching thing for a little bit, and I still do. But man, it's the life of travel. I love if I'm traveling for lifestyle. If I'm traveling for business, I hate it. Can you imagine going to an awesome city every week and only seeing the airport and a convention center, right? Or like the inside of a hotel? Like that's not fun. It's not exciting. You're spending your life on the airplane. And
is your day filled with meetings from morning to night? What do you do? What's your role in now?
What do you even do, Tim? Like,
right. Do you still? Are you still picking up the phone asking for money? Are you?
Yeah. So I'm pretty good at it, and I really like doing it. And I think as you grow your business, everybody thinks they need to come into this like CEO role of just being a puppet master and pointing people in the right direction. And somebody early on told me, like, listen, I own my own business, but I love coaching and consulting, so I still do that. And I hired a CEO to my own company, but she still owns it. And so that was pretty eye-opening to me of like, oh, I can still do the things that I like doing, even though I own the business as well. And so I found the highest value of my time is social media, right? Like I have identified the revenue generating activities in my business, and I've put captains, essentially C-level executives in charge of every single one of those, which is finding deals, raising money, and then operations. And so I have engines to my machine, and I am the fuel that feeds those engines. So by me hopping on a podcast or me creating social media content or posting a video on YouTube, that allows people to see that and say, you know what, I like what these guys are doing. I want to be part of it. Maybe I can send them a deal that they buy from me. Maybe I can buy a deal from them. Maybe we can joint venture on a deal. Maybe I can lend them money, or I'm a vendor, I'm a supplier, I'm a contractor, and I can do business with them in some capacity. Or, they join our mastermind community and our coaching community, right? And so the more I'm out on social media and stuff, it allows me to do that. But like the one-time speaking engagements and travel, I don't like doing that because I can create endless amounts of content in a day and a half, the same time I would spend on traveling. And then it's evergreen. It's out there forever, right? And so it's just trying to work smarter instead of harder. So one day a week, I just rip out content, and I'll sit down and I'll do one of my podcasts called Spill the Beans, which you got to come down to Charleston for. I only do it in person, But I'd love to have you down here, man. And
let's do it.
Yeah, and grab a cup of coffee and just kind of fly on the wall. What do entrepreneurs talk about? So I do 1 or 2 episodes of that one day a week, along with creating a little bit more content. But that gives my videographer. I have 2 people who handle videography and editing, and my social media accounts. And so I post on my own account, but really their job is to make it consistent and post every single day. So I'll batch the activity and film one day a week, and then they will cut it all up and drip out content every single day so that we're always relevant, but that way it's not me working on that every single day. I respond to a lot of messages and comments and that kind of stuff. So I engage in that, and a lot of time gets sucked up in that on a daily basis, probably 2 hours of it. But I like, having conversations, like seeing some of these young kids. Yeah, I'm 18 years old and I want to go buy some property. I'm like, damn, that's awesome. That's really, really cool. Or how do I level up, and how do I scale? How do I get on my job? Like, I don't know. I love having those conversations with people. So I engage with a lot of that. And then, I need to do a better job of like taking care of myself. Like I'm very good at time blocking to go and work out. Like right before this, I was at the gym, got back, cleaned up, jumped on here. But I need to take a little bit more time, just like meditate, go for a walk. I don't do enough of that. Sometimes you get caught up in the weeds, but I like to think I'm a very present parent. I take my kids to school, get them ready in the morning, hang out, do puzzles before they go off to school, whatever. And then when they get home, I try not to do, any podcasts or anything like that. So you're an exception though, because I love you, buddy.
Well, I appreciate that, man. We love you too, man. So yeah. How about the books? I know you guys were writing children financial books on financial literacy for kids. Are you guys still doing that?
Yeah. So, we have a company called Little Legacy Library, where we take a lot of the concepts from classic personal development books, Think and Grow Rich, How to Win Friends and Influence People, The Magic of Thinking Big, a lot of these kinds of books. And we've taken them and we've boiled it down to a couple different, really, really great concepts and made them in children's versions, right? Start planting these seeds and educating when kids, their personalities are developed in the first 5 years of life. And so these books are kind of written kind of Berenstain Bears level, right? Like 4 years old to like 9 years old is kind of the sweet spot. Although I had a lot of adults who were like, man, don't tell anybody, but I learned a lot from that book,
I'm reading them.
Yeah. So, I mean, they're really good. I sat on the idea for several years and then finally partnered up with my wife and one of our best friends, a girl I went to high school with, and our families vacation every year together. And she's got kids the same age as our kids. And so we ended up writing these stories, and we have 4 books out now with workbooks. We want to do more. We want to do some events. We want to get entrepreneurs with their kids together and come out and really start working on these things, right? Like I had to learn this stuff after school, right? Can you imagine having these thought principles and philosophies ingrained in you from an early age? And it's not like, it's not necessarily entrepreneurship. There's a lot of entrepreneurship, but it's influence. It's being relevant. It's being confident. It's setting goals. It's whatever you want to achieve, no matter what that is. How do you know? Like, nobody ever taught me how to set goals in high school or college. Nobody ever taught me how to manage money. It was always a joke off class, right? It was always one of these like, screw around, come in late, leave early, goof off. It was like the money management class in school. And so, we got several awesome books. They're available at littlelegacylibrary.com. But yeah, check those out. They're really, really powerful, and we're super proud of them. And eventually we'll get into like doing some events and maybe doing even some cartoons or something along those lines to really push it quite a bit more. But yeah, we're pretty proud of it. And that's kind of an impact piece. That's one of those things where when it's like Spider-Man's aunt said it, right? Like when you're given great ability, you have great responsibility. Given great power, you have great responsibility to deliver on it in a positive, impactful way. And so that means a lot to us.
Absolutely. Well, man, I tell you what, thank you so much for all this great information.
Absolutely.
Definitely.
Yeah. It's awesome being here, man. I always enjoy our chats, and you always ask great questions. So, and you're an easy person to talk to and communicate with, and would love to connect in person. Like I said, if you're ever down in Charleston or want to come hop on my podcast, would love to have you, buddy.
We'll do it. We'll make it a point to happen. And guys, we hope you enjoyed this episode, learning about syndication and how Tim has really gone through the trenches. And, the key points are stay true. I mean, it's, think about others first. And there are ways to get through whatever hardship or downturn. I mean, it's obvious. He's proof of it. And he's winning today. And he's sharing everything that he does with you. Follow him on social media, guys. We appreciate you watching. Until next week, see you soon.